All right, guys, welcome to the channel of Live Life in Maine. In this episode, I'm going to show you a mortgage hack. I'm going to show you how you can use the bank's money to pay down the bank's loans. It's not really a hack. It's just the way the compound interest works. I'm going to talk to you about two different types of mortgages out there or loans, and how you can use one to save tens of thousands of dollars on another one. So we're going to get into a little bit of arithmetic. I hope that's not a problem. If it is, just replay this video over time and time again, but I'm going to show you this because it came to light that not everybody's aware of this. I just found this out the other day that I'm talking to one of my clients. She had no idea how an amortization schedule works. So I'm gonna get into some numbers. I'm gonna use a fictitious couple that had a mortgage got a mortgage back in 2020, January 2020. They got some equity, and I'm gonna show you how you can save tens of thousands of dollars a month by using, again, the bank's money against himself. So if that's of interest to you guys, well, then stick around because we're going to get after it right now. All right, guys, welcome back to the channel here at Live Life in Maine. If you want to know everything there is to know about living, eating, sleeping, breathing, working, having fun, things to do, places to go, things to eat, places to eat, you name it, here in Maine, well, then I would encourage you to subscribe to this channel and tap that bell to be the first to be notified when I drop new content, which I'm doing on a weekly basis now, pledge that I made in 2024. Guys, my name is Scott Tebow. I'm a realtor. I'm a real estate agent broker with eXp Realty. More importantly than that, I'm not just a broker. I'm a father of 5, got a house, wife, kids, got a couple of grandchildren now. I'm a veteran. I've also bought and sold properties as an investor. I flip properties. I have owned a few houses myself. So I'm pretty well versed in the industry. I've actually developed property. I developed a mill that was built between 1820 and 1850 with a developer. I was just a minor part in that development. He was the major stakeholder, but we partnered up, and I helped him develop a mill right here in Biddeford. You talk about getting into a lot of things. Look at infrastructure that was built back from 1820 to 1850. Imagine what it takes to develop that. But anyways, we get calls, texts, emails all the time from people just like you, looking to move here, looking to understand more information about Maine, wanting to know what it's going to take, wanting to know different places to live, wanting to know what the market's like, looking at some houses. And we love it. We help those people. We've helped a lot of people move here from other states. We've helped some people leave here and move to other states. Not necessarily leave here permanently. A lot of kind of my age and older. I'm in my mid-50s. They're starting to retire or early retirement and looking for winter homes in Florida and some places warmer. As you get older, your bones get a little bit more crinkly. So I get it. My wife and I may do that someday, but I do love living up here. So she's from Texas, so not so much right now because it's cold, but we do this all the time, guys. So if you're interested in understanding more about the Maine market, interested in maybe moving here, wanting to know facts, data, want to look at some houses online, or even have me do videotapes of them, that I would encourage you to drop me a line, send me a text, shoot me an email. The information is below in the description, and I'd be glad to help you. Guys, I made a pledge. I get this question asked a lot, and that is, am I going to be working with you, or am I going to be working with your team members? And I made a pledge that if you come to me through a YouTube video, then you'll be working directly with me. I won't pass you off to one of my team members. To be fair to you, though, that is how things sit right now. I'm not so busy that I don't have time to work with people that I get from YouTube. I get maybe 2 or 3 a month. I don't work really with more than 10 or 12 people at any one given time because I just don't think I could do them justice if I was working with more than that many people. So I'm not one of those crazy brokers who's got to be working with 50 people and closing 20 deals a month. My goal is kind of 2 to 3 a month, but those are the things that that's the way I work. And if we ever get to that point and we're working together, then we'll definitely have conversations about it, but it hasn't been a problem so far. Just throwing that out there. But guys, as I said, in this Got some notes here. In this video, I'm going to show you a mortgage hack. Now, some of you may be aware of this, and some of you may not. And let me tell you why I decided to do a video on this, because I was surprised. I have a client. She's in the medical professional. That's all, she's in the medical profession, so I'm going to say she's a medical professional. And, you know, she's pretty well off, right? She does well. She's looking to make a major purchase for a house, quite a few hundreds of thousands of dollars, a lot of them actually, and she's asking me, you know, going to make an offer. Well, anyway, she was sitting down with one of her girlfriends, I guess is a CPA for one of these big companies up here. And her friend said, well, how much are you paying for the house? And she told her, and she said, do you think the value is there? And she said, absolutely. Why has the house been on the market so long? And she said, from what I told her, and it's true, some of these higher priced houses, the ones that are over 800, 900,000, they sit a little longer because you don't have as many buyers. And she said, no, definitely it'll appraise, been through it, love it, it'll appraise, no problem. And then her friend asked her, well, what are you paying for interest rate? And she said 7.25%. And her friend said, are you crazy? You're going to pay 7.25% for a mortgage, for that type of mortgage here in Maine? You know how much you're going to pay for that house? And she said, yeah. My client, yeah, I'm going to pay what I bought it for plus 7.25% in interest. So, you know, I might pay an extra 50, 60,000 in interest, because what she did was she took the whole amount and multiplied it by like 7.25% and came up with like $57,000. I can't remember what the exact number she told me was, but, and her friend said, oh, no, I'm sorry. You're mistaken. And I'm not going to get into the names, but she goes, you're going to pay over $2 million for the house. And she goes, no, that's not true. How's that possible? And, you know, being a CPA, she pulled out her phone and pulled up a mortgage calculator and typed in the amount and typed in the interest rate and typed in the term 30 years. And then she scrolled all the way down to the bottom of the table and she showed that she's going to pay almost $2 million in interest. And of course, the price of the house, which was over $800,000. So she said, that's almost $2 million. And my client was like, what? How does anybody buy a house? I got to go talk to Scott. This is not right. Something must be wrong. So she calls me in a frantic, not really in a frantic. She kind of was laughing. She goes, I need to understand something. Am I going to pay $2 million for this house? And I said, what do you mean $2 million for this house? It's only, you know, the value of this house, the purchase price of this house is, I'll give it away right now. It was like $810,000. And she's like, yeah, but I was sitting around my friend and she said, over the course of 30 years, it's going to cost me. And I'm like, okay, well, let's back up. Your friend is very correct. If you pay for this house 30 years and you just pay your minimum monthly payment, it is true, you're going to pay, and we did it together, I think it was $1.157 million in interest on top of the principal. And she sat back and said, why does anybody buy houses at this price? And I'm like, you know, it's interesting. Most people just don't want to look at that number, right? It is, when you go to a closing and you sign the documents, they do provide you an amortization schedule, shows you how much you're going to pay for that house over the course of 30 years. If you amortize it out over 30 years and you just pay your monthly payment every month for 30 years. It's interesting also that prior to, I think it was 2015 or 16, it used to be a number right in the upper right-hand corner on the first page of the truth and lending statement. This is how much this house is going to cost you over 30 years. And now it's kind of buried in a lot of paperwork. You do get this stack of paperwork, and, you know, if you flip through all the pages, I think it's, you know, there's 18 or 19 pages of an amortization schedule for 30 years, and it shows how much the interest rate, how much the interest is, and what you're going to pay at the end of the term. And every time I go to a closing, whether I'm selling a house or buying a house, most of the title attorneys and title agents that are closing the loans say, you can look at this, but I wouldn't look at it really, because you'll be depressed. And, you know, interestingly enough, a lot of people don't look at it. They're like, yeah, I just know I'm paying a lot for this house. And they're more interested in what the monthly payment is than what it's going to cost them over the long term. So I think it's very important that you understand not only what your monthly payment is, but what your buying and what the investment is and how long you're going to pay it off and what's your strategy, because it would be ridiculous for my friend to pay my client to pay almost $2 million for this house. It may be worth $2 million 30 years from now, who knows? But that's a lot of money that the banks make in interest when you buy a home. And it's just the way a compound interest works and the way a mortgage works. So let me explain to you two things. You may already be aware of this, guys, but I'm going to explain anyways, because in my prior videos, I talk to you like I have to be talked to like I'm a sixth grader, right? So are you smarter than a sixth grader? So I like that talk to my clients that way because that's the way I like to be talked to. So there are two types of mortgages that we're going to talk about, or loans that we're going to talk about in the housing market. There's what is a typical mortgage, fixed rate, 30 years. Most people love those types of mortgages because they can budget for it. They know the rate's going to stay the same and the monthly payment's going to stay the same for 30 years. And they like that because they kind of budget how much can I afford and what's it going to cost me. Obviously taxes change every year or may go up or down, but usually they go up in utilities and all that. But just principal and interest is going to be a fixed rate, a fixed amount every month for 30 years. So most people like that, right? However, that type of mortgage is a closed-ended loan. And what do I mean by a closed-ended loan? Let's say you got a mortgage and let's say you're $300,000 on it and you're paying, I don't know, $2,000 a month. And you buy a lottery ticket or a scratch ticket and you win $250,000. And you are smart enough to take that $250,000 and you apply it directly to your mortgage, bringing your mortgage down from $300,000 to $50,000. Well, your mortgage payment's not going to change. Your mortgage payment's still going to be $2,000 a month until one of two things happens. One of three things happens. The first thing is that what's owed on your mortgage is less than your payment. So in other words, when your mortgage gets below the balance of $2,000, you're not going to have to pay a $2,000 payment anymore because it's going to be less. Number two, you've paid it off. Or number three, you refinance. Actually, there's four things. Number four, you could sell the house or sell the property and move to something else. But that's a closed-end loan. The payment does not change. It stays no matter how much money you put towards principal. That payment's going to stay the same until you get that balance down below either the monthly payment, or you've paid it off, or you've refied, or you've sold it. So that's one type. Most people have those types of loans, that closed-end loans. I have that. It's a mortgage, 30 years fixed, does not change. The other type of loan one I'm going to talk about is a line of credit, or a HELOC, which stands for Home Equity Line of Credit. And that's an open-ended loan. And what do I mean by that, or a line of credit, is you can borrow money, take it out, pay it back, and it goes up and down. In other words, if you borrowed $10,000 from a bank on a HELOC or a line of credit, we're going to call it, and you pay back $5,000, well, then you have $5,000 more available to you because you took out 10, you paid it 5, and you got 5 back. So that's open-ended. It goes up and down. And more importantly, the interest rate and the amount that you pay on that HELOC is based upon what the balance is, not what your original origination was, right? Not if on $10,000, this doesn't stay fixed. It changes as you pay down the principal or as you pay down the balance. So that's an open-ended loan. And what I'm going to talk about is how to use an open-ended loan or a HELOC to pay down your principal mortgage and save tens of thousands of dollars. So let's get into it. We're going to get into it right now. The first thing I did, guys, was I did a little research. I went online and I made up a fictitious couple. I want to say Fred and Sally. And Fred and Sally bought a house in January of 2020. And I went into the computer and I looked at what was the mortgage rates back in 2020. And in January of 2020, they were 4.51%, which is pretty good. That's kind of a balanced interest rate, right? Anything between 4 and 6 is a good rate. Start getting above 6, it gets a little bit more pricey. And when you get below 4, you're going to find out that a lot of people aren't making money. We just came out of this crazy 3% and 2.5% interest rates because the feds gave away all this free money trying to keep the economy and stimulate the economy. Well, now we're paying it all back. But 4.51%. So they bought a house. They took out a $400,000 mortgage on it January of 2020, and their interest rate is 4.51%, and they did it for 30 years. So guys, their monthly payment would be $2,029.12. That's the principal and interest on that loan. Doesn't count for taxes, doesn't count for utilities, just a P&I, the principal and interest. They didn't have mortgage insurance or anything like that. They just had principal and interest. So the second thing I did was I went online and said, what's the average value of a house in America today? And it came back to be like $440,000, which I was surprised because that's pretty high, I think. You know, houses in Mississippi, I know don't cost that much. Houses in California, Mississippi, the cheapest state to live in. Houses in California, the most expensive state to live in, I'm sure it costs 3 times that. Maine, we're kind of in the middle. We're kind of right around that price, actually. We're actually, as a state, lower than that price. I think I did the average price of a house in Maine in general, and I think it was around $350,000. Now, it's a lot. It's more than that, obviously, in southern Maine, which is where 40% of the population live. But in general, it's $350,000. I think in southern Maine, it's like 100, 120, 130,000 more than that. But I digress, just kind of getting into what this is going to all equal. So I ran a loan amortization schedule. And I said, all right, Fred and Sally, they've owned this home since January of 2020. So they've been into it now for a bunch of months. Let me put the paperwork here in order. And they have decided that they're going to try this program, and they're going to do this thing. So the first thing I did was I ran an amortization schedule, and if you notice on your screen, I'm going to show you if they didn't pay anything more to principal, just kept on making their monthly payments for 30 years, which is 360 months. You'll see in the far right-hand corner, which I've highlighted, they've paid $330,482.71 in interest on top of their principal payment of $400,000. So they paid $830,482.71 for this house. That was back in 2020. This is now 2049 when they paid it off. So their house is probably going to be worth that in 2049, but still they paid almost as much in interest as they did the principal, and that's where the banks make their money, right? So what I did was I said they're going to take this program, they're going to take my advice, and again I want to make sure you guys understand. I'm not a CPA. I'm not a financial expert. I'm not giving anybody advice. I'm just showing you a way that you can use a closed-ended loan to pay down open-ended loan to pay down a closed-ended loan, and how it works. I would recommend talk to a tax professional, talk to your own CPA, talk to somebody that you trust, that cares for you, that knows you, understands your financial situation. I want to make sure I'm a real estate broker. First and foremost, I'm just giving you guys some tips. I've done this with my mortgages. I've done this with some of the houses that I've owned. It does work. You just kind of have to know how to do it. So here we are. It is January of 2024. They've already made their mortgage payment, so I'm going to skip forward to February. Next month, they take and they put $12,000 down on their mortgage on top of paying their monthly payment of $2,029.12. I'll explain to you where I get the $12,000 in a minute, but just hold on for a minute, though. So it shows that by doing that, they paid $14,029.12, $12,631.88 went to principal. So you notice if they paid $12,000, only $631.88 of their monthly payment went to principal on top of the $12,000. And if you look at this amortization schedule, you'll see that a lot more is being paid in interest than is being paid in principal in the beginning of your loan. I think that break-even point, it's like I want to say it's year 15, year 16, something like that, where you stop paying the interest and the principal is the same amount that's being taken out of your payment every month. But so they took $12,000 and they paid it down. And if you go to the end of the amortization schedule by doing that, you're going to see that they took their schedule from 360 months down to 342 months. So what does that mean? That means now, instead of having to pay on a mortgage for 360 months, now they only have to pay on that mortgage for 342 months. That's 18 months of payments that they save by putting that $12,000 down next month. Well, if you take what their monthly payment was, which is $2,029.12, and you apply you multiply that by 18 months, you'll see that that number comes out to $36,524.16. Again, you'll see that number, if you multiply 18 times $2,029.12, is $36,524.16. Guys, write this number down, follow along with me so you understand the math like I'm doing it to you, okay? So again, they put $12,000 down in February of 2024, which is next month. Let's say they do that again, but they do that 5 years from now. In February of 2029, next month, 5 years from now, they put down another $12,000, and they put it directly to the principal. In other words, in 5 years from now, in February of 2029, they're going to make their $2,029.12 payment. They're going to put $12,000 down. That means they paid $14,029.12. However, you'll notice that their interest of that, you notice that their payment from their principal that was applied, the amount that was applied to, what am I trying to say here, Scott? The $2,029.12, only $847.66 of that payment went directly to principal on top of their additional $12,000. So you see, even 110 months into having a mortgage, is their interest and principal not the same yet? They're still paying more for interest than they are in their principal balance. But in this example, they put down an additional $12,000. So $14,029.12 went to their principal in February of 2029, as I have highlighted here on the screen. All right, let's go to the end of it. Let's go to the back of the amortization schedule. Remember, it was 342 months when they did it the first time, right? So now they applied another $12,000, a total of $24,000 directly to their principal. And it took their mortgage payments down from 360 to 342, and now it's at 328 months. So that's another 14 months, right? 342 minus 328 is 14 months. So if you take $2,029.12 and you multiply that by 14 months, you're going to save $28,407.68. When I say save, you're not going to pay that, right? That's how much money you've saved off your mortgage by doing this. But you've put $24,000 down now. So write that number down, $28,407.68. All right, guys, we're going to do this one more time just to really show you the fact of how this works. So 5 more years, so 10 years from next month, 5 years more, right? In month 170. Now we're in 2034, February of 2034. They put another $12,000 down, right? So they put a total of $14,029.12 down. $12,000 was their payment that they put down in principal. $2,029.12 was their mortgage payment. Of that $14,029.12, you'll notice that $117.89 went directly to principal. So guys, in month 170, you're finally starting to see that more is going to principal on your monthly payment than is going to interest. Not a lot more. $2,029 minus $911, it's almost half. It's like $1,100 is going to its principal, $900 is going to interest. But anyways, they're going to show that they did that one more time in month 170, 10 years from now. And what did that do to their amortization schedule? What did that do to the loan? It knocked off another, what I'm going to say, 10. Yeah, we went from 328 months down to 318 months. If you take 318 months and if you take the difference between 328 months and 318 months and you multiply that by $2,029.12, you can see that that was another $20,291.12. Right? So they paid $36,000 on their mortgage, directly to principal, in 3 payments over 10 years. One next month, one 5 years from next month, and one 10 years from next month. So again, I asked you to write these numbers down. Just humor me for a second. So the first time they did this, they saved $36,524.16. Second time they did this, they saved $28,407.68. Third time they did this, they saved $20,291.12. Those 3 numbers equal $85,222.96. Sorry, guys, I make sure my audio is still going. But that's how much money they saved on their mortgage. Now, this is the hack, and this is how it worked. But they paid $36,000, and I asked you to hang out with me, where are you going to get that money from? Let me explain to you where they got that money from. Well, they went to the bank this month, and they got a home equity line of credit for $12,000. So another research item that I did was I looked up what are the typical HELOC rates right now, home equity line of credit rates, and I discovered they're kind of high. They're 9.75%. So they said, sure, we want to borrow $12,000 versus against the equity in our house. We'll pay it back. We'll pay it back over 5 years. So what they did was they got approved. They got $12,000 out. As long as you have equity in your house, you can get a home equity line of credit. There are some rules. Typically, banks do 80-20. Some of them are doing 90-10. What do I mean by that? They'll loan you up to 80% of the value of your house minus what you owe. So you're going to have to do your own calculations, but take whatever you think your house is worth today. If you don't know what it's worth, ask a realtor in your area. If you're here in Maine, you can ask me. You can look it up on Redfin. You can look it up on Zillow. They're a little high. Take like 2% off those numbers. But in general, you can look them up and then multiply that by 80%. And that's how much the bank is willing to let you borrow. And then from that number, subtract what you owe on your mortgage, and that's how much equity the bank will allow you to borrow, if hopefully it's in the positive. What I did do is I noticed that the average mortgage fee, the average mortgage amount owed in America, I think was $338,000 in 2024, and the average value of a home was $440,000. So most people have equity. Obviously, if you just bought your house just yesterday, you probably don't have a lot of equity unless you put a lot of money down or you got a good deal. A lot of good deals aren't out there right now. Most people are paying at or a little bit above listing because there's such a housing shortage. But Fred and Sally went to the bank, and they got a home equity line of credit for $12,000 at an interest rate of 9.75%. They hemmed and hawed because that 9.75% seems high. And if you run the amortization schedule on a home equity line of credit, you'll notice that their monthly payment for that $12,000 was $253, and the total interest they would have paid on that home equity line of credit was $3,209. So they took out 12. They paid the $12,000 back plus $3,209. So let's go back to the numbers that I just shared. As you remember, we just took $85,222.96 off your mortgage by putting 3 payments of $12,000 down over the course of the next 10 years. One next month, one in 5 years, and one in 10 years. However, you did put down in principal $36,000 because you went to the bank and you did this 3 times. You got a HELOC for 3 times of $12,000. So that's $36,000 that you did pay back. And you paid interest on that HELOC of $3,209, was it? And that HELOC, I just want to make sure my numbers are correct. And that HELOC cost you, yes, $3,209. And you did it 3 times. So that HELOC in interest would have cost you $9,627. Okay? Here's the arithmetic, guys. $85,222.96 is how much you saved off your mortgage by showing you what I showed you could do. Go and get a HELOC, put it directly to principal, do it 3 times over the course of 10 years. Subtract the $36,000 that you borrowed from the bank but paid back. Subtract the $9,627 that you paid in interest. Well, if you take $85,222.96, subtract $36,000, subtract $9,627, you'll notice that you saved yourself $39,595.96 off your mortgage by using the bank's money, one loan, to pay down another loan. It didn't cost you anything. one could argue, yeah, it did. It cost me $9,627. I say it didn't cost you anything because you saved $39,595.96. The question is, if I said to you, give me $9,627 and I'll give back to you $39,595.96, would you? I think most people would. That's a pretty good return, but you got to look at it that way. So a couple questions that I get asked, why don't I just take that $12,000 and instead of paying the bank $253 a month, which is the principal and interest, the principal is $200, the interest is $53. Why don't I just take that $12,000, divide it by 60 months, right, or 5 years, which is an additional $200, and why don't I just apply $200 additional to my mortgage every month for 5 years? Wouldn't the number be the same? The answer is no, it would not be the same because the way compound interest works. So the way compound interest works is it takes a prior balance and it always calculates, it doesn't adjust because your rate and your mortgage number stays the same. It's a fixed loan. So run your own amortization schedule, guys. But if you did that, instead of doing what I did, you'll see that in the first time you did that, after 5 years, you would have reduced your monthly mortgage payments. You would have went from 342, which you would have went from 360, down to 344 months versus 342 months, right? So doing it the way I showed you, you're actually saving an additional 2 months of mortgage payments. Now, to be fair, if you say, all right, 2 additional months, what does that really make me? Well, if you save 2 additional months, if you save 2 additional months, 342 versus 344, if you do just putting $200 a month, you would have paid an additional, my way, you would have saved $4,058.24, but you would have paid $3,209 in interest for that first term of 5 years on your mortgage, on your HELOC. So if you subtract the difference, you're going to make $849.20. You saved yourself $849.24 doing it my way. Paying the bank on that HELOC, the high interest rate of 9.5% over the course of 5 years. You're still saving yourself money. Again, guys, this is one of the hacks that a lot of people aren't aware of that I'm finding out. You know what? Some people say, I take my mortgage, I divide it in half, and I make a payment every 2 weeks. And by doing that, I'm going to make one extra payment a year. That's true, but you got to understand the way the closed-end loan mortgages work. You make a payment half, you still got half outstanding, you make the other payment, and they apply it to your principal and balance, right? They apply, and they keep on doing that until you owe less, you've paid more than what your payment's for, right? You have an additional $2,029.12, and that generally doesn't bake out until close to month 11 or month 12. And that's really where you see the interest payment go down, is month 11 or month 12 into that payment. So even though you're doing that, and I agree, again, guys, you should accelerate your mortgage as fast as possible. I agree. If you can, you should absolutely do it because paying the bank all this money and interest is crazy. Whatever you do is a good thing. I'm just showing you a way to do it fast, a way to accelerate your mortgage. Now, there's a couple of caveats that you have to understand. And I'm only telling you this because I learned this myself, I don't know, 15, 20 years ago, maybe. Yeah, it was early 2000s. I was in IT then. I ran a couple IT companies, and my company had a good quarter. My division had a good quarter, and I got paid a big bonus. And I took half of that bonus and I applied it towards my principal of my house, or so I thought I did. So I just sent it in. And I noticed that the next month, my interest principal didn't go down that much. And I said, why didn't you apply this to the principal? And they said, well, we didn't know, Mr. Tebow. We figured you were just making your payment, so we applied it towards your payment for the next month, and the balance of what was left over, we did apply that to principal. And I said, oh, no. I wanted you to apply it all to the principal, and I would have made my normal monthly payment when it was due. And they said, well, we didn't know this, so we just assumed you were just paying your payment early, and we applied it directly towards your towards the monthly payment that you owe. And I said, okay, that's fine. What happened the next month when I sent in that payment on the 5th? They're like, well, we just assume you're applying it to your next month payment, paying 1 month ahead, so we applied it to the next month payment. And they'd keep doing that until, there was extra money versus what the payment was due, because it keeps the interest rate high. It keeps what is coming, the compounded interest numbers keeps on high. And I said, that's a ripoff. And they're like, well, you got to let us know, Mr. Tebow. We don't know what to do with your money. And to their credit, I guess they're right. So if you're going to make an additional principal payment, make sure the bank, your lender, knows it, because if they do not, you need to tell them, essentially. You need to call them, send them an email, whatever, make sure they correspond with you. Hey, I'm making an additional payment. I want it to be directly applied to principal, because if you don't do that, they're not going to do it. They know what they're doing. Let's put it that way. So make sure you do that. That's the first caveat. The second caveat is you got to have some discretionary money, right? So in this case, friend Sally had $253 left over a month after all their bills were paid. They took that $253, they put it towards their home equity line of credit, and they paid down their mortgage $85,222.96. Guys, you got to look at things. A lot of people take money out of their homes and they go on vacation, or they buy cars, or they buy stuff that depreciates, or, I get it, you get the memories, I get it, you get to drive a nice car for a while, but investing in real estate is a long-term gain. It's not a short-term gain. You got to be in it for the long term, and not just real estate, anything. And guys, I'm not standing here on my pulpit preaching that I'm a financial guru. I can only tell you what I've applied in my life. I have no bills, no credit card bills. Yes, I have monthly living expenses like oil and heat and electricity and the internet, and God knows how many TV subscriptions for all the kids in the house and my father and my wife. But the only thing I actually still own is my house, and I have like 3 times the amount of, the house is worth 3 times more than what I owe on it right now. So I think I'm in pretty good shape. I don't live paycheck to paycheck, thank God. But I did a long time ago, and I remember it was a struggle. And I said, what am I going to do, right? I'm not going to keep on doing this. And I immersed myself into financial literacy. Unfortunately, they don't teach you this in high school, guys. My kids didn't even know how to bounce a checkbook. They didn't even know what a checkbook was, matter of fact, because everything's online. Again, I'm Generation X, so wasn't born with the internet. We're a different kind of breed, I guess. We figured things out. Nobody came to save us. And if you're one of those people out there, then you know what I'm talking about. If you're a millennial or Gen Zer, here to help you guys. Listen to your Gen X's, because they know what they're talking about. Anyways, where was I? You just got to understand how the banks work. And I'm going to share one last thing with you, and this is on interest rates. So how is the interest rate calculated? Like when you look up and you talk to a mortgage broker and they say, all right, now the interest rates are 7.5 or they're 8 or whatever, where is that number coming from? So this is what banks have done. We're going to go back to Sally and Fred. In January of 2020, the interest rate a mortgage that a bank's going to lend you, or a lender's going to lend you, a mortgage company, is based upon the 10-year Treasury note and a bump up of what they apply, right? So what's the 10-year Treasury note? So what a 10-year Treasury note really is, it's the feds telling the private sector, lenders and banks, this is what you can buy money at. So back then, the 10-year Treasury note was like 1.89%. Imagine buying money at 1.89%. Some people may say, what do you mean buying money? Isn't money money? That's where you got to understand the cost of money. So in order to borrow, the bank's going to borrow from the feds $1 million, let's say. They're going to pay 1.89% interest on that money, which is the 10-year Treasury value at that time, to borrow that money. Then they're going to charge you that money, and this is where they make the spread. It was generally 1.5% to 2% higher than what they borrowed it at, because they have their costs. They got to pay for their bricks and mortar. They got to pay for their people. They got to make sure the asset is producing, not a non-producing asset, not in foreclosure, not in bankruptcy, right? So they got to make sure that's their due diligence, their appraisals, their inspections. They're making sure you're a good paying person. And so they loan you the house, they loan you the money at about a 2% kick, 1.5 to 2% above what they borrowed it for. That was back in 2020, guys. And that's how you get to the 4.51% interest, because if you take 1.88 and you multiply by 1.5 to 2%, you're going to see it's about 4.51% additional money that they are applying towards what they borrowed it for. Fast forward to 2024. I just looked it up yesterday. The 10-year Treasury is 4.08. I'm sorry. Yeah, I wrote it down somewhere. It's 4 something, 4.9, 4.8 something. But not are they just applying 1.5 to 2%. They're actually applying almost double that, 3 to 3.5%. So if the 10-year Treasury was 4.25% right now. That's in other words, what they can borrow money at for. They're marking it up 3%, and that's how you get your 7.25%. Well, why are they doing that? Why are they now doing it 3% versus 1.5, 2%? Well, 2 reasons. Number one, because they can. All the banks are kind of doing this. We're all, and I call it, in cahoots together. And I'm not putting banks down. We need them. Obviously, we need lending. America's still a great bet. Investing in America is still a great bet. Buying houses is still a great bet. Houses are having appreciating. Great bet. But they know that as inflation starts to settle down, and where did inflation come from? Well, a lot of people can say it's part of the administration's policy. A lot of people say it's come from COVID and all this free money. I think it's a combination of both. But I'm not going to get political because I'm trying to stay neutral. If you want to get political, we can get political, but that's for a different conversation. And I'm probably going to turn off most of you because I definitely fall on the right side of the aisle. I'm not far right, though. I'm kind of moderate, but just fall on the right side of the aisle, if that gives you any indication. I'm ex-military, so most not everybody, but most of us fall on the conservative side. But the point I'm trying to make is the reason why they're charging more is because they know, because of inflation, interest rates are going to be high, because the feds are trying to curve off inflation. And truthfully, I mean, I'm going to give this administration a little kudos right now. Inflation's down to 3%, right? I think it's some of their policies. I think there's a lot more that could have been done, especially on the energy side. But let's give them some credit where credit's due. Inflation's down to like 3%. So as interest rates start coming down, the banks and the lenders know that we're going to refi, or those people have these high interest rates are going to refi, right? So they're going to, that money that they were going to make, or that money that they would have made between when they borrowed, when they gave the loan to when they refi, they needed to make more of it faster, right? Because they have costs, right? They have their own costs internally. That is why the interest rates are, 7s, and we're all the way up to the 8s, because the feds increased the rates. But also because the lending community also had to step on it a little bit more to cover that spread, right? So as things start to normalize and interest rates come down, you'll see banks and lenders not making as much of a spread, because they figure once you get into a solid interest rate, you're not going to refi, right? So they're going to be able to count on that money, assuming you're a good payer and you pay your payments on time and you don't default or anything like that. So that's kind of where it comes from, guys. It comes from the 10-year Treasury, and multiply that, add about 3% onto that right now, 2.5%, 3%. You'll see those numbers come down, and I'm going to leave you this. I've told you guys this in other videos. I believe in late third quarter, early fourth quarter of this year, we're now in 2024, you'll see interest rates around 6%. Maybe a little bit more. I know there's prognosticators out there saying interest rates are going to stay up for the next year. I think somebody just financial JP Morgan, somebody just said interest rates aren't going to change. I do see them come down, but I guess we're going to find out. Come back in September, October, November of this year, and let's see where interest rates are, and we'll see if I'm right or wrong. I'm going to tell you right now, I think interest rates are going to be between 6 and 6.25%. They're going to come off 100 basis points, or they're going to drop at least a point. We're going to see some Fed drops, and obviously that is dependent upon what happens in this crazy world. We're not in a nuclear war. The Straits of Hormuz weren't bombed. something crazy doesn't happen, where you become a little bit more energy independent. But if everything kind of stays the same, normal, and it's crazy what's happening in the Middle East, and that's a powder keg. But let's just, for the sake of this conversation, let's say things aren't too crazy. I see interest rates being between 6 and 6.25%. So, guys, I hope this video was helpful. Take it for what it's worth. You're not paying anything for it. Again, if you want to explore this yourselves, pull up your own amortization schedule, look at your mortgage, run an amortization schedule. You'll see that your payment and how your principal and interest works. You'll see what happens if you put more money to it, whether you have it laying around the house or whether you got to go borrow it from the bank on a line of credit or whatever. You'll see how that works. Unfortunately, what a lot of people do is they don't take that money, like I said, and put it back into the house, either fixing it up or replacing things. They go out and buy cars and go on trips and vacations and pay down credit card debt just to turn around and do it again, just feeding good money after bad money, and it just continually makes your situation crazy and worse. What was COVID? Right after COVID, the average debt in this country was almost paid off, in terms of not what the country owns, but in terms of credit cards. Now we're up to $1 trillion. What do people do with all the money? Instead of investing it, instead of what, they went to the malls and they went to buy all the stuff. That's why we had a pretty good third and fourth quarter last year, because they took all that free money and they applied it and they bought things, and it drove up the stock market with people making things. Well, Piper's coming due, man. You got to pay those fees, and pay those bills. Anyways, I'm ranting, so I'm gonna let you go on this, guys. Have a safe week. Talk to you soon. I'll see you next week, and drop me a line, send me some comments. Let me know if you want to know more about this, or if you want to know more about the Maine market. If you're interested in different areas other than this kind of southern Maine, anything you want to know about Maine, let me know, guys. Comments. Info is in the description below. And until then, be safe. Have a good weekend. It's a big football weekend. Looking forward to it. Take care, guys. Talk to you soon. See you later. Bye-bye.